Hello, everybody. This is Alan Ellman, the blue collar investor, welcoming you to this BCI podcast number 141, titled The Stock Repair Strategy. We're going to be using a real life example with Lyft Inc., which trades on the NASDAQ exchange under the ticker symbol LYFT. Let's start off by defining what is the stock repair strategy. Well, when we own shares at a higher price, let's say significantly higher than the current market value, we're in a losing position. So the break-even price point can be lowered by purchasing one near the money call option. So a call option that's trading whose strike is near the current market value of the security, which once again is lower than the price we paid for the stock, and funding that call option by selling two out of the money call options with strike prices between the current market value and the original purchase price. Now, this strategy is also known as a 1-by-2 ratio call spread. Keep in mind that this strategy does not start out as an option strategy, but rather as a stock-only strategy. However, we can integrate options to mitigate our losses. Now let's take a look at the advantages of this stock repair strategy before we get into the Lyft example. We have the opportunity to lower our break-even price point without adding any significant amount of cash to the trade. Now let me, for a moment, give you an example of what some retail investors do. Let's say a stock is purchased at $50, 100 shares at 50, and boom, it drops to $40 a share. Now we own $100 at 40 when our break-even price point is 50. Now what some retail investors may consider is buying another 100 shares of that stock at 40, thereby averaging down the break-even price point from 50 to 45. However, in that scenario, we're adding 100 times 40 or $4,000 to what is already a losing trade. By using the stock repair strategy, we can actually lower our break-even price point with maybe a small debit or sometimes even a small credit, but certainly not adding any significant amount of cash to the trade. So this strategy can replace averaging down, where we would be adding a lot of additional cash to, again, what is now a losing trade. So let's move on to the disadvantages of the stock repair strategy, because there is no one strategy that's a panacea and only has benefits. And certainly this stock repair strategy falls into the category of having both pros and cons. We must be willing to forego additional potential profit in exchange for lowering the break-even price point. And the second disadvantage is that if the price of the security continues to fall, lowering our break-even price point is not going to help. So we're going to continue to lose money. So those are the two main disadvantages of the stock repair strategy. Now let's turn to our real-life example with Lyft, when you could see from this chart that if the trade was entered where the top red arrow is, if it declines in 1 month to where the lower red arrow is, the price dropped from 64.16 all the way down to 52.61. So a very, very significant decline in the share price in only 1 month. So how are we going to approach it? Well, once again, we're going to buy a near the money call option, so a strike price near 52.63, and we're going to fund that by selling two out of the money call options, which will have a strike price somewhere between 52.63 and the original 64.16. So here's how it worked out using the option chains at that point in time, keeping in mind that Lyft was purchased at 64.16 and is now currently trading at 52.61. And in this hypothetical example, which is actually a real life example, we're going to assume 100 shares. Now, anytime we do option strategies. Each contract is going to consist of 100 shares of the underlying security. Okay, so we're going to buy a near the money call option. Now remember, Lyft was trading at 52.61, so we're going to buy 152.50 near the money call option. And at the time I made this screenshot, the cost was $3.75 per share. Now we don't want to pay that. We want to fund it by selling two out of the money. In this case, 57.50. Remember, that's between the 52.61 current market value and the original 64.16 price that was paid for Lyft when the shares were first purchased. Okay, so the break-even price point, as you'll see in a moment, is lowered from 64.16 to 58.64, and the spreadsheet will show us that we only cost us 25 cents per share to do so, $25 per contract, and that allowed us to lower our break-even price point about $5 and change. Now, we must use this strategy in 100 share increments. That's just the very definition and nature of stock options. So here is the BCI stock repair calculator available in the BCI store, spreadsheet we created specifically for this strategy. And you'll notice that on the top red arrow, it shows you the stock purchase price at 64.16. So that's your original break-even price point. Now, by buying the 152.50 near the money strike at 375 and funding it with two out of the money 57.50 strikes at $1.75, that's going to cost us 25 cents a share, as you see here where my cursor is, and that will lower the break-even price point from 64.16, and the lower red arrow shows you down to 58.46. Now, once the trade is complete, at the end of the contract, we can enter our final stats, and it will give you your final results at the very bottom of the spreadsheet. But in terms of lowering our break-even price point by $5 and change, you could see here the spreadsheet will show that it will cost 25 cents per share. Sometimes there'll be a credit. So it could be either a small debit or a small credit, once in a blue moon, a precise break-even, but never adding a significant amount of cash to the trade. And that is the nature and definition of the stock repair strategy. So once again, to summarize, this strategy will lower our break-even price point by adding only a little cash, sometimes no cash at all, to the trade. And there may even be a credit. On the downside, we must be willing to sacrifice upside potential. And we must understand that if the price continues to decline, this strategy actually will not assist us. Okay, so that takes care of that. And if I can get my slide to move over here, there we go. I want to tell you of a moment before I leave about the BCI package, which is our best and most comprehensive educational product available in a package form. It has 18 components, 6 courses, online courses with downloadable workbooks, 6 calculators, including the stock repair calculator that we created and therefore found nowhere else, 5 of our best-selling books in ebook format, and our 13-month annual premium membership, which includes 4 reports of eligible option selling candidates, along with over 200 training videos and much more. I will also want to point you to our other best package, which is the Trade Management Calculator package, which includes a new spreadsheet developed by the Blue Collar Investor, the only one of its kind anywhere, and our 8th book, the new exit strategy book. You see an image of it over here. I'm not going to go through all the details of these packages. Each one has a video like you see here, so you can go through that video and decide whether or not this is the right package for you. Go to our website. You see at the bottom here, thebluecollarinvestor.com. Click on the link Best Discounted Packages, and you'll have both the BCI package and the Trade Management Calculated TMC package videos to evaluate. You can also go to our store to purchase items individually at thebluecollarinvestor.com/store. So, ladies and gentlemen, that ends our BCI podcast number 141, the stock repair strategy, folks. I hope you enjoyed my presentation, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.